high-quality portfolios of Australia's major REITs and an ongoing flight to quality will underpin continued low vacancies across their portfolios in the face of rising economic uncertainty and structural transitions. A key example of how this will benefit the demand for space in the major REITs portfolios is in the office sector, where vacancy levels in newer and higher quality buildings remain significantly below those of older and lower quality buildings, and the delta continues to increase. Further, increasing focus on sustainability by companies is also expected to benefit demand in the portfolios, with major Australian REITs having been at the forefront of reducing emissions and improving the environmental efficiency of their buildings. We expect similar dynamics to support the REIT's retail and industrial portfolios as tenants focus on leasing space in prime locations and in the highest quality buildings to meet their environmental targets and maximise cost efficiencies. One of the key credit strengths for the major Australian REITs is their longer dated lease expiries. These underpin the stability that the REITs demonstrated during the pandemic, particularly in office, and we expect they will continue to support the office sector as companies adapt to their new working structures. On the flip side, REITs can pay a price for this revenue certainty. Locking in tenants for longer delays the REIT's ability to participate in market upswings, like that seen in the industrial sector since the beginning of the pandemic. As a result, a large proportion of their properties still remain under-rented into 2023. The proportion of under-renting will decline across the year as more leases are renewed, but we expect the delivery of extensive development pipelines over the next few years to be the REIT's main opportunity to take advantage of the higher market. The rise in base interest rates will likely see valuations across all sectors soften. This could create challenges for the REITs around project economics and returns and funding targets, especially for those REITs with a focus on loan-to-value metrics. Debt costs are also expected to rise as the rate hikes flow through, which will see a weakening of cash flows. We expect the strong financial profiles of the REITs to absorb the rising interest rates, but believe that the lower valuations could lead to some volatility in the shorter term. Nevertheless, overall we expect REITs decision-making to be driven by longer-term fundamentals, such as the flight to quality in office, changing consumer habits in retail, and the rise of e-commerce and inventory levels in industrial.